AI continues to dominate the earnings conversation so far, but our next guest says investors should check their exuberance. Joining me now is Noah Solomon, Chief Investment Officer at Outcome Metric Asset Management. Thanks for coming in.
Thanks for having me.
All right, let's talk Mag 7. They did beat expectations for the most part latest quarter. NVIDIA, though, has yet to report. Are there any headwinds for this group?
I think so. The question is always when. So notwithstanding whether they beat their earnings this quarter or last quarter or next quarter, which we'll find out in the fullness of time, if you look at the S&P 500 index, it stands at basically at the second highest multiple it's ever had in the post-war era, with the exception of the late 90s tech bubble. Now, is it a warning sign or not? Well, historically, it's been pretty clear. You've kind of had three episodes. So in the late 20s, it reached its highest multiple it had ever reached as of that time, and we know how that ended. And then fast forward to the tech wreck, it reached the highest of all time, and we know how that ended. Then in 2008, it traded at the second highest multiple it had ever traded at, with the exception of the tech wreck, and we know how that added. And here we are today at the second highest level, with the exception of the tech. Now, that's the S&P 500. Now you have to divide it. So if you look at, it doesn't mean I'm bearish on US stocks. That multiple is largely driven by the Magnificent Seven or the mega tech stocks. And in part, it's not the stocks per se, which are amazing companies. Let me be clear, this is not the late 90s where you had a bunch of companies that turned out to be not real. They went to zero. These are amazing companies that generate tremendous earnings and have done tremendously well. But as of recent, they've gotten an extra lift off of the, AI
build out.
craze.
Sure.
AI build out, whatever you want to call it. So I'm not bearish on US stocks per se, and I'm not even bearish on the Magnificent Seven. All I'm saying is historically, these peak valuations have been followed at some point, and they can still go up a lot more, but at some point, every time you've had a comeuppance whenever you've hit this kind of range in terms of multiples.
So there has to be a deflation at some point, is what you're thinking.
Exactly. It's not that I don't believe in the promise of IA. To be clear, I think that AI will be transformative in the way we live our lives and the way businesses do things. But I still, notwithstanding that I think this is a real thing that will have tremendous transformative impacts for as far as the eye can see in almost all aspects of life, or corporate life certainly, but I'm still wary of the shiny new toy, what I call the shiny new toy. So if you look at the historical pattern of shiny new toys, all of those peak valuations that I described in the 20s, in the internet bubble, even in 2000, they were all preceded by some shiny new toy. Every bubble has been spurred by some new invention that they think will be transformative and has unlimited profit potential. It was canals, railroads, automobiles, electricity, telephones, and every time it led to some euphoria and a no price is too high.
And that's where you get into trouble.
And that's where you get into trouble.
Okay.
You can have both things. You can still be amazing, but I don't believe no price is too high.
Okay. I think, and this is a question I'll phrase this way. When we first heard AI, everybody's sort of grabbing at anything associated with AI. It just had to be some way associated for making its way up. Do you think perhaps investors are being a little bit more discerning now? And I ask because you do see some of the Mag 7 doing much better, some of them flagging a little. We saw Supermicro and AMD report, and they're not doing as well. So are investors beginning to be a little bit more critical about where they put their AI money?
I think they are. This is clearly, as I said, this is not like the late 90s. And again, the late 90s, the internet did prove to be transformative, as we know today, but there was still, prices can still outrun even the greatest potential. So we are more discerning. We're not doing that today, even within the Mag 7, to your point. But if you look at the multiples, they're still very challenging. And that doesn't mean that things have to crash, that you're going to have an accident. But don't underestimate the ability of prices to outrun even the greatest promise. If you look at, here's a great example of the Mag 7, Microsoft or Amazon. They're great companies today. They were great companies in the late 90s. However, prices ran ahead of the reality too fast. So in the late 90s, do you know Microsoft and the tech wreck declined over 60%?
I remember that time.
Amazon, almost 90%. I don't know many, and notwithstanding that they recouped those losses and went on to tremendous new highs, I don't know of many investors that can hang on for a ride.
Yeah,
like
they got
that.
pretty battered. Okay, let's talk about where you are overweight in defensive stocks, or why you're overweight in defensive stocks and what those are.
Well, obviously, there's both sides of the ledger. Part of it is what you are wary of that forces you into being defensive. So I am wary of the growth stocks for the reasons that I cited. I also think that defensive stocks, particularly dividend-paying stocks, which tend to be defensive stocks, I think that interest rates are going to decline. I always thought there was a much better chance over the near term that they'll decline, query on how much or how fast, then rise. We're getting more evidence of that based on the latest U.S. payrolls, which came out where the revisions were significantly negative. I think the Fed is likely to cut rates 2 or 3 times this year. Historically, defensive dividend-paying stocks tend to do particularly well in times when rates decline, because rates are declining for a reason. It's because growth and the economy and employment are declining or decelerating. So that hurts high multiple stocks, it hurts growth stocks, and it's friendly because dividend-paying stocks acts as a proxy for bonds. So when interest rates go down, it makes dividend-paying stocks more defensive.
You still like gold as well, and we are seeing some gold stocks in the past couple of days pushing back up. I'm just wondering if that would change moving forward, considering the possibility of that rate cut.
I'm a little wary of gold for the following reason. Not because I think gold won't do well or will do well. It's not because of Evo on gold, but if you look at gold stocks, in the last 6 months or so, they've become much more correlated with stocks in general. So historically, golds have a very low correlation. So in addition to whether you have a positive view of gold or not, they have tremendous diversification value. Today, they've become much more correlated with stocks because I think they're in vogue. So when people feel good, they buy them. When they feel not so good, they sell them, like stocks in general. So their diversification value isn't what it used to be. I think that's because they've become sort of a fast money toy. So it's not that I like or don't like gold, but be aware from a diversification perspective, they're not what they were a year ago.
Yeah, historically, people bought gold and just held it.
That's right.
Got it. All right. I will leave the conversation there. Noah, thanks for coming in again.
Thanks very much for having me.
Noah Solomon, Chief Investment Officer at Outcome Metric Asset Management.